Hey, good morning, everyone. Marty Mazzora here, June 19th, 2021, with your weekly macro update. Lots to share with you this morning, so I'm going to just jump right in. In front of you is our simple graph of our PWA macro index, 48 data points to give us a feel for general conditions. We went down a few points this last week to 37.5. Still a pretty good score. If we were charting this like anything else, we'd be a little concerned here because we have a lower high. Not really concerned with the data, though. I think recession risk is very low at this point, although some would tell you that the Fed is threatening to tighten monetary policy, and it would be a bad time to do that, and that would force a recession. Very interesting cross currents in the financial markets that we'll get to some of that here in a minute. But in terms of the Fed, they had their meeting on Wednesday, and it's interesting because if you look at headlines, it says that they moved up the time frame for raising interest rates. Jerome Powell hinted that they may taper some of their spending on bonds. And I think that's not unlikely in the relatively near future, partly because he was willing to go there without completely discounting it. He went there, though, with promises that to the extent that we do taper, so to speak, it'll be small and we're going to remain very, very accommodative. With regard to the move up of anticipated interest rate hikes, that went from 2024 to 2023, and it showed up in what's called the dot plot, where each Fed member places a dot relative to where they see interest rates and when. And there were some dots that showed up as interest rate increases in 2023 to the point where we should take it seriously. Of course, that's still 2 years away. One thing that Jerome Powell said in his press conference is take the dot plot with a grain of salt. So he's about as dovish as they come, but there are other people on that committee who are concerned. James Bullard, the St. Louis Fed president, I believe it was on a CNBC interview. I just read about it. I didn't see the interview, but apparently he said, this inflation is something to take seriously. Worse to that effect. And we are going to have to tighten monetary policy sooner than later. Markets had a rough day yesterday, and it's presumed it's largely because of that interview. I noticed that Neil Kashkari, who is a very dovish member of the Fed, came out later and basically said, we ain't doing anything. And maybe not even in 2023. So he's really sensitive to market action, as is Jerome Powell. So interesting to see the stock market. Dow was down 500 some odd points yesterday. Clearly, it's just evidence, as I wrote kind of sarcastically in yesterday's morning note, that this market is not the least bit concerned with fundamentals at this point. All it's fueled by, maybe that's an exaggeration, but much of what it's fueled by, if not the majority, is just money printing and the idea that there's going to be sloshing liquidity around the world. So much so that the excess will flow to equities and that the powers that be will keep interest rates pinned to the floor. Now, the reality of the interest rate setup, and this is what I've been preaching now for a long time, is that we have the biggest debt bubble in history when we look at government debt to GDP and we look at debt on corporate balance sheets. Rising interest rates would be, and I don't want to exaggerate it, but they would be, catastrophic's a big word, hugely detrimental to the economy because it could essentially pierce these debt bubbles, and debt bubbles are where big crises come from. So hence we have a situation where, we have GDP expected to grow at, 7% this year. You have, CPI, you have inflation that's rising across the board, more so when you actually go to the grocery store and so forth. We all see it more than what the indicators are suggesting. Fed funds interest rate near zero. You have stock markets at all-time highs. This is a setup that virtually demands that the Fed raise interest rates, tighten up on liquidity, so that this train doesn't pick up so much momentum that you can't stop it. Well, If they did that, I just said it, then I think you ignite a ginormous fire in the debt markets, and I think they're scared to death of doing that. So interesting setup for sure. Plays into what we're investing in, and I'll go through some of that with you here. But I've been saying that at best I've been neutral on commodities in the short run. It's been a crowded trade. What I keep telling clients in meetings and to people within my organization is the commodities trade makes more sense to me than it ever has. The only thing that really troubles me in the near term is that it makes more sense to everybody else than it ever has as well. So I don't like being that much in the consensus. You like to be not in the consensus and let the consensus come to you, but that's short-term stuff. So it would make sense that as things correct, things like materials and other commodities and even gold and silver correct a little harder. That does not change the longer-term thesis. It does have us adding a little extra hedging in the short run because we don't want to take huge hits to the point where we might get shaken out of a position. So I'll share a little bit of that with you as well. So anyway, let's get moving here and go through some of the data points that I want to share with you. First one, retail sales. So we had year-over-year retail sales up 28%. Of course, that's good, right? But you look at the base effects, where we were a year ago, right? And it's down from the 50% increase we were the month before. The thing to be concerned about is on a month-over-month basis, they're actually negative 1.3%. Online retail sales actually kind of, flat to down a little bit. And the rate of change, even from the year over year is down 47%. That's just, the up 50 to the up 28. That's interesting because that flies in the face of this big, huge, roaring 20s type, breakout in the consumer and pent-up demand. But I think it also speaks to having got a stimulus check lately. So these numbers are weird, they're distorted and so on. So right now that knocks us down from bullish in terms of the score in our index to neutral on retail sales just for the moment. Housing permits for single-family homes, they came down a little bit, lowest since September of 2020, which would be just follow it back to this point right here. Housing starts, I didn't pull up that chart, but they were actually up a little bit, but they weren't as good as expectations. Also, mortgage apps, which I didn't run the chart this week for you, but they actually rose 1.6% week over week, but they're down 17% year over year. Refinancing actually jumped 5.5% after 3 straight months of declines. And so here's the housing index, which is, I call it the home builder confidence index, which is essentially what it is. That came down again, so it's an 81. Now 81, as you can see, just look to the left, is historically high. But again, we're looking at rate of change. They simply can't deliver affordable new homes. Of course, it's the higher cost and declining availability for lumber and other building materials. So basically what we have is we have home prices that are just essentially priced out dramatically, in many cases, the first-time home buyer. Also, these supply constraints are resulting in insufficient appraisals, and they're making it more difficult for builders to access construction loans. Then you also have, and I showed this on the blog already, you have sentiment in terms of the environment on behalf of the buyers in these consumer surveys is like as bad as it's ever been. So the consumer is saying it's a terrible time to buy a home. Sellers think it's a great time to sell a home, and that's been proven to them in the marketplace so far. Folks, it's just a phenomenal amount of government intervention throwing liquidity in the market. And it comes out in traditional places by creating very bubbly conditions. And it creates some new stuff like, cryptocurrencies that people get excited about, but all that liquidity makes them very bubbly and very risky. Weekly jobless claims actually came up a bit to 412 after 6 straight weeks of falling. So they went from 375 to 412, something to pay attention to. Continuing claims came in at 3.5 million, and it was an estimate of 3.4 million. But no big move over the previous week. I think we can suffice to say that as those generous unemployment benefits begin expiring, we're going to see some pretty dramatic positive action in these jobless claims numbers. Okay, so commodities. So finally, we can completely forget about these flag patterns that have been showing up here, right? We had just a big precipitous drop. And again, folks, back in here, this is what I was talking about, expecting some consolidation and wondering. And I said, can we get, but particularly with copper, which I'm going to show you in a second, can we get something more dramatic? And I kept saying, oh, absolutely. In fact, it would be safe to assume that. Well, we got something more dramatic right in here. You can see we bounced back a little bit here, particularly groceries did. We had a really good day. Friday, overall, it was a really rough day, but ag was one of the two or three components in our core portfolio that actually did quite well. So this was to be expected. Again, just look at this rise. This was such a crowded trade, too much optimism and so on. Doesn't change the fundamentals, in my view. It just shows us what kind of volatility there are in asset markets, particularly when they keep going up. But going up does not mean you want to get out of something unless you're absolutely a short-term trader. It may mean that you want to hedge against some sort of a waterfall sell-off, which I've seen happen multiple times in my career, and we'll talk about that again in a second. But no, this was to be expected. We'll see if commodities don't get bought up like they did here, but that remains to be seen. And then copper, this is the one that I was really pointing these down arrows. Remember, even here, I said, we may break out, but could we go much, much lower in copper? Absolutely. I mentioned what China's trying to do to tamp down on metals prices. Huge, huge parabolic move. I showed you a quote from the world's second largest commodity trader here the other day that said copper is here to stay in an upward trend for multiple years. Well, the fundamentals certainly support that. And the big push to renewable energies absolutely support that. Copper is, along with, lithium and other rare earth miners, but copper is at the top of the heap of the necessary metals to make all this happen. So while we've got a very decent pullback here, if I was a long-term investor and I wasn't in metals, I would start scaling in here. Could we go much lower? Sure, we could. Long-term, should this bother us? Absolutely not. This is the nature of investing, particularly in assets that have such huge potential, and people just get too excited about them all at once. So it was a crowded trade. That's why I kept pointing down these down arrows the last few weeks. But fundamentally, nothing's changed, at least at this moment. And when it does, and our thesis changes, then we're going to express that view in our portfolio. Right now, we're expressing a view that commodities are a good place to be. Interesting, this last week, despite commodities prices, the Baltic Dry Index just shot through the roof, right? So this is the cost of moving bulk goods across the world's oceans. And, it speaks to perhaps lack of ships, lack of containers, and so on and so forth. But it also speaks to the fact there's a tremendous amount of activity and a tremendous amount of demand on shipping. And that, you'd have to say that's an inflationary signal there as well. Although, as you can see, this is a very, very noisy indicator. And then the Treasury bond to stock ratio. So the S&P 500 versus TLT, which is 20-plus year Treasury ETF. When this is going down, stocks are underperforming bonds. So you can see here that stocks here just recently have just rolled over. So that's a negative. It's actually a negative sign about the economy, right? Bonds would rally and so forth. Or, bonds are rallying because they know the Fed is there to support it. Or bonds are rallying because they think the Fed is going to tighten and mess up this economic growth that we're seeing and actually force a recession upon us. Probably the latter, but a knee-jerk reaction, I think, to just the hint that the Fed just isn't going to lay down and just print money every time the wind blows. Although that's what they're doing, and frankly, that's kind of what they're going to continue to do. But any hint that they might turn down the spigot makes the markets nervous, and that's reflected in this indicator right here the last few days. Okay, so here's what I would call the most important chart or graph in the world right now, and it's the dollar. So remember I said how well the technicals work on currency trading, at least that's been my personal experience, and this was all bullish, but I said I was bearish fundamentally. So look for resistance at the 50-day moving average, and then if we shoot through that, and I were a short-term trader, I would probably sell the dollar. I didn't do it so well, but right on that line right there, right? Well, we closed just above it, but also I've been saying each week, we go up here, and really blow through that. That is going to play utter hell on asset markets, stocks and commodities as well. So what's been happening, folks? We've had this big surge in the dollar, and stocks have begun to roll over. The Dow in particular had its worst week since last October. I think a bearish longer-term view for the dollar is more than appropriate under these circumstances. And I'll say it one more time, because if this continues, it is a holy mess for markets, therefore for policymakers. So speaking of commodities or currencies, if you will, you can argue gold's more of a currency than a commodity. Here's our chart of gold. Okay, so here we had a rising wedge, which as we know is bearish, right? We broke down through that, lost the 50-day moving average. It's beginning to roll over, lost support here at 170, and we're sitting here right above this pretty strong either support or resistance line and closed just above it on Friday. Okay, so we actually got a little creative the day before the Fed meeting, and we just bought a real short-term, crazy cheap put. It's like mounted to 0.01% of our core portfolio. And what Nick and I decided was that, that there's the Fed, if they even hint of tightening, the stock market's going to hate it, but gold's really going to take a hit. I'm talking about, 5 to 10% hit. So we could mitigate that at almost zero cost if we just bought a put with the expiration of Friday. 2.5% out of the money is what we ended up with. So clients, you'll see this quick activity over a couple of days on your confirmation statements. So we did that. Gold sold off maybe 1.5%, so didn't even come close to where we were. But of course, implied volatility in gold picked up, so the put jumped. It about doubled in value. I'm looking at that, knowing that this was not a big hawkish move, so we're not going to get that big move, at least I thought. So Nick said, why don't we just roll it down $1, get our money out of it, and then we'll leave the rest of it. So we did that. And I know this is getting into the weeds, but so we basically pulled out our basis, so didn't cost us anything, and moved the strike down $1. And then that just kind of meandered. And by the end of the day, I thought, we made a little money on this. We were up about 60% on the option. Again, it was not enough to really move the needle. And I instructed Nick to just go ahead and dump it right before the close. And then overnight, gold rallied. Made sense to me. Well, wake up the next morning, and in the cash market, suddenly gold began to roll over. So then I'm spending a good part of the morning just really looking at charts and thinking about what Jerome Powell said and looking at the crowdedness in the gold trade and everything else, and still liking it a lot going forward. Nothing about the long-term thesis at this point has changed, but my short-term thesis got a little more negative, right? It's still very, very crowded. We didn't shake a whole lot of people out. Gold, even during the go-go inflation years of the 70s, it was a great place to be. It had some huge drawdowns. And so we're sitting with about 10, 11% of our portfolio in gold, which, again, feels safe, but it's noticeable if it goes down a bunch. So we went in yesterday and bought a put option for everybody, covering their shares, with a 160 strike, I believe it is. Yeah, right here, out through September to get through what is often tough seasonality. It amounted to like 0.1%, 0.15%. It's actually up 10% yesterday. Gold came down after we bought it. We bought it as gold began to rally. Hopefully it'll just expire worthless, right? And just really not even move the needle on our performance for the year. But it protects us against something really big to the downside. So we've been building these commodities positions, and particularly with ag and with metals, they've exceeded my expectations on a short-term basis, which concerns me because then you get the big drops. So as I already shared with you, we've hedged the ag portion all the way out to October against something big, and now the gold position as well. And when you look at how crowded the stock market trade is, and you look at people who are just loaded up in these cryptocurrencies and all these kinds of things, I mean, there's just kind of risk around every corner. What keeps things afloat is the Federal Reserve and this attitude that they will print, till the cows come home to keep everything afloat. Well, when they hint that maybe they won't, of course, that's when markets get into trouble. The other side of the policymaker coin is, of course, fiscal policy that comes from Washington. The commodities trade is built for that because really what they have to work with is infrastructure. That's going to directly add to money supply. If the Fed continues to accommodate that, which they have to, that feeds other factors do as well that I've shared with you, but that really feeds the longer term inflationary thesis. The only thing I didn't mention is, the Fed talked about cutting back its asset purchases, and that got the market upset. Last week, their balance sheet rose by 112 billion in 1 week. So there was nothing about last week that suggested that they're at least actively right now lightening up on sticking money into bank reserves and all the things that happen with quantitative easing. In fact, quite the opposite happened this week. So that's interesting as well. Another chart I thought I'd throw up this morning is on financials. So financials have taken a pretty big hit. And the client asked about that. So, I bet a lot of people are wondering, thinking about that. So we had, with my dotted line here, you can create your upward wedge, which is bearish. We had kind of a nice channel going here, broke through the 50-day moving average, which is now flattening out. And clearly, I don't have a line drawn there, but I'll draw one. Clearly, there's some support right there. You can see how it was resistance and then became support and so forth. We break through there. Financials, it can get ugly for financials as well. Notice down here, though, and this is the case with others as well, and I think I loaded up the materials chart for you too. Financials are as oversold on the relative strength indexes. They've been all the way back here to last March. So this, on a short-term technical basis, while these are bearish signals, right, wouldn't surprise me if the market bounces next week, or when the market ultimately does bounce, if we get a pretty nice bounce out of financials. You can see where this oversold line is at 30 on the RSI. We're below that now. Of course, we were below that here. We're just touching it back here in July, August of 2019, and we moved from there up to these highs and so forth. So gotta like financials if you like the economy going forward. You certainly have to like financials in an inflationary environment, because to the extent that the Fed allows interest rates to move, well, then higher interest rates, that makes for better net interest margins on bank lending, so that's a positive as well. So this is a reaction to the rally in bonds, the fall in interest rates toward the end of the week, but we like financials here fundamentally. They're cheaper than most sectors still. Really oversold right now historically. So we'll see what happens next week. And next week's going to be interesting. Could we get some follow through on Monday? Oh, absolutely. We closed kind of in a real negative position on Friday. If we see Fed governors come out and really walk back what Bullard said on Friday and so forth, if they go the route of Kashkari and Powell, well, then, you might see people come rushing back to the market, and with the Fed promising not to kill the golden goose just yet. And then lastly, material stocks, which are about 15% of U.S. equity exposure for us, broke down through this upward trend line, broke through the 50-day moving average, looking really ugly. We had our bearish divergences, but really, really oversold as well, right? Same kind of thing as we saw in financials. If I had to make a bet between financials and materials, given where the oomph of government spending globally is going to be, I would choose materials over financials, but prudence says own both, be very, very diversified, have foreign exposure today, which we do. Foreign stocks are a lot cheaper than U.S. stocks by most metrics, if not all, pay a much nicer dividend, have underperformed for too long, and really thrive in a weaker dollar environment, which, as I keep saying, is what it really has to happen. Oh, and before I close, there was one I meant to show you that I forgot. And I'm going to pull up one more chart, then we're gonna say goodbye. Crescat Capital, I like those guys. They do a lot of really, really good work in the precious metals and the mining space. So they put out this chart. It's a little blurry, but you can read up here: commodities to equities ratio. So when this line is going up, commodities are outperforming stocks. When it's going down, commodities are underperforming stocks. And I've shown you that chart that commodities have been in a 10-plus year bear market that they're just now breaking out of. And commodity bull markets tend to go for a very long time. So they're pointing out that ratio is lower than it was during the early 70s when commodities broke out to the upside relative to stocks, lower than it was when the tech bubble for stocks burst and commodities broke out for a long time relative to stocks. And so you can see here's the opposite, right? When they were peaking, well, notice here we are, a long, long ways away from peaking in terms of the commodity to stock ratio. And you can see how these trends tend to work. When you look at how asset classes tend to change leadership over time, It seems like the stars are aligning for commodities going forward. Certainly, Crescat believes that. Our own work suggests that that's a possibility enough to definitely exploit it with a part of our portfolio. But yeah, so what they're suggesting is that we're going to see a nice period over the next number of years, not necessarily days, weeks, or months, but years. And that's what we're suggesting as well, while staying diversified and now even hedging some of that commodities exposure that's been so good to us of late as well. So, folks, I will leave it there. I hope you have a wonderful weekend. Talk to you again soon. Bye-bye.